Cochin Shipyard is currently on fire in the stock market. Its stock has hit the upper circuit for 4 days in a row, and in just 5 days, the stock has jumped by about 20%. Now, before we get into the reasons behind the surge, let's understand the company. Now, Cochin Shipyard is owned by the Government of India and is the largest public sector shipyard in the country. Now, it's basically where some of the biggest ships, including vessels for international customers, are built and repaired. Now, think of it as India's go-to place for building and fixing giant ships. Now, the company earns most of its money, about 59% from making ships and about 31% from repairing them. They've even got international orders from big companies in Europe, Middle East, America, etc. Now, let's talk about why Cochin Shipyard stock is surging right now. Now, there are a few key reasons. The overall market is in a positive mood, and defense stocks in particular are seeing a lot of buying interest. After the Maharashtra elections, public sector stocks have also been gaining traction, and Cochin Shipyard is riding that wave. Now, the company also recently secured a new deal. Now, Cochin Shipyard signed a memorandum of understanding with Seatrium USA, a partnership aimed at designing jack-up rigs specifically for the Indian market. Now, what's a jack-up rig? It's a type of mobile offshore drilling unit used for oil and gas exploration in shallow waters. Now, by teaming up with Seatrium, Cochin Shipyard is positioning itself to tap into growing demand for these rigs in India. Now, let's look at the bigger picture. Over the past 5 years, Cochin Shipyard has delivered multi-bagger returns. It has made a lot of money for its investors. But here's an interesting twist. If we zoom in on the last 6 months, the stock has actually fallen about 18% from its peak. Now, why? The dip was part of a broader trend in defense stocks. Investors were super optimistic about growth, which pushed prices higher. Plus, market sentiment and liquidity added an extra pay premium. Now, in mid-2024, the defense sector then saw overvaluation concerns. The market began to worry about whether companies like Cochin Shipyard could maintain growth and secure fresh orders. Now, these concerns led to a dip, but it's just seen as a temporary issue, not a long-term problem. Now, let's take a closer look at Cochin Shipyard's performance. Firstly, India's consistent increase in defense spending has been a major growth driver. Over the past few years, the government has raised the defense budget from 4.78 lakh crore rupees in fiscal year 22 to about 6.22 lakh crore rupees in fiscal year 25. Additionally, the Make in India initiative has been a game changer for domestic manufacturing of defense equipment, creating significant growth opportunities for companies like Cochin Shipyard. Now, the company itself is performing well. In fiscal year 24, its revenue turnover grew by 56% year over year, driven by strong growth in both shipbuilding and ship repair. Now, EBITDA margins have also been improving steadily, and net profits have also shown strong growth. Now, Cochin Shipyard's order backlog stands at about 22,000 crore rupees, which is over 5 times its annual revenue. Now, this provides the company with clear earnings visibility and positions it well for sustained growth in the near term. On top of that, the completion of its dry dock and international ship repair facility expansions has also doubled its operational capacity. Now, this allows Cochin Shipyard to take on larger and more advanced projects such as LNG carriers and next-generation aircraft carriers, significantly boosting its capabilities and competitiveness. Now, while Cochin Shipyard is in a strong position with a robust order book, capacity expansion, and improving execution, its growth beyond will only depend on the timely delivery of current projects and success in winning new opportunities. And as we always say, valuation too remains a key. On November 7, 2024, Cochin Shipyard announced that they're paying an interim dividend of 4 rupees for each share you own. Now, what does that mean? If you own shares of the company, you will get 4 rupees for every share you hold. Now, the record date for this dividend is November 20, 2024. This means that if you own shares of Cochin Shipyard, on that specific date, you will get the dividend. If you buy the shares after November 20, you won't be eligible for this payout. Now, speaking of PSU stocks and dividends, the government has updated the rules for how PSUs manage their money the first time since 2016. Let's break this down. Now, PSUs now need to pay about 4% of their net worth as dividend instead of 5% earlier. This means they'll pay slightly less, giving them more room to invest in their business. Now, if a PSU wants to buy back its own shares, it needs a net worth of about 3,000 crore rupees, and earlier it was 2,000 crore rupees. And it also requires at least 1,500 crore rupees in cash reserves, which is up from about 1,000 crores. Now, these higher limits make sure only strong companies can do buybacks. Now, bonus shares are when a company gives extra shares to its shareholders for free. Now, PSUs need much stronger finances for this, and the reserves must be at least 20 times their paid up capital, double the earlier requirement of 10 times. Now, this ensures only well-performing companies issue bonus shares. Now, a stock split is when a company divides its shares to make them cheaper for small investors. Now, new rules say PSUs can only split their shares if the share price is 150 times its face value, and earlier it was just 50 times. Plus, they must wait at least 3 years between two splits. Now, what's the big picture of these changes? Now, these changes make sure PSUs act responsibly with their money. They still reward investors, but now they'll also focus more on reinvesting in their growth. Now, the stricter rules for buybacks, bonuses, and splits mean only financially solid PSUs can go ahead and make these moves. Now, for investors, this is a step towards stronger and more disciplined public sector companies. It's about balancing short-term rewards like dividends with long-term growth. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.